Inflation is stubbornly high, mortgage rates are soaring, and many forecasters believe a recession is inevitable. The Bank of England raised interest rates by half a percentage point on Thursday after data this week revealed surprisingly stubborn inflation at 8.7%. The move will pile pain on people with mortgages and put more downward pressure on house prices. The bank rate set by the Monetary Policy Committee has gone up to 5% from 4.5%. There is a particular concern over the core inflation rate, a measure which strips out volatile factors such as food and energy, which has been going up. The bank has to balance the risk of damaging the economy, which has shown little sign of growth, with its battle to slow price rises. How do interest rates affect? First of all, mortgage time bomb is unleashed by Bank of England. The average maturity of UK mortgages is much shorter than in the United States, with 2-year and 5-year fixes the most common. Many mortgage holders due to refinance their loans this year and next bought their homes when interest rates were much lower and mortgage rates were closer to 1% or 2%. According to the Institute for the Fiscal Studies, if rates remain at the level, households will spend almost £280 more on their mortgage each month on average, compared with what they were paying in March 2022. Some 800,000 fixed-rate mortgages are due to expire in the second half of the year, according to the UK Finance. Another 1.6 million mortgage will need to be refinanced next year and at significantly higher rates. When interest rates rise, more than 1.4 million people on tracker and standard variable rate deals usually see an immediate increase in their monthly payments. The rise from 4.5% to 5% means those on typical tracker mortgage will pay about £47 more a month. Those on SVR mortgage face a £30 jump. Since December 2021, that's an increase in monthly repayment of £465 on a tracker and a £297 on an SVR. Three quarters of mortgage customers hold a fixed rate mortgages. Their monthly payments may not change immediately, but house buyers or anyone seeking to remortgage, estimated to be 1.8 million people this year, will have to pay a lot more now than if they had taken out the same mortgage a year or more ago. The so-called mortgage boom has become a huge economic and political issue. An average 2-year fixed deals, which was 2.29% in November 2021, now above 6%. As people roll off cheap fixed rate deals onto products with much higher rates, their monthly repayments can become hundreds of pounds more expensive. The Institute for Fiscal Studies, a political independent economic focused think tank, says a rising interest rates could mean 1.4 million mortgage holders see their disposable income fall by more than 20%. Number second, house prices to fall further. The latest spike in mortgage rates will hit demand for house purchases and ultimately house prices. Head of UK residential research at Real Estate Age expected that house prices across the country to fall 5% this year and another 5% next year. If interest rates must stay here for longer to tame inflation, house prices could fall more sharply. If mortgage rates were to stay at 6% for several years, a house price fall of 25% would be likely. Credit cards and loans. Bank of England interest rates also influence the amount charged on things such as credit cards, bank loans, and car loans. Even ahead of this decision, the average annual rate in April was 21.86% on bank overdrafts and 20.13% on credit cards. Lender could decide to put prices up further if they expect higher interest rates in the future. Recession. Fears that the British economy is heading for recession mounted sharply Thursday after the Bank of England raised borrowed cost by more than anticipated, seeking to combat stubbornly high inflation with a hike that will hit borrowers hard, particularly homeowners who have to refinance in their coming months. The increases will clearly come at cost, and there are concerns over the outlook for the British economy, which has so far avoided falling into recession even as Europe's economy contracted slightly in the 6 months ending in March. Pressure on borrowers. Higher interest rates help lower inflation by making it more expensive for individuals and businesses to borrow, meaning they potentially spend less, reducing demand and pressure on prices. The UK rate hike will pile further pressure on borrowers, particularly the 1.4 million or so households that will have to refinance their mortgages over the rest of the year. Those on the variable mortgages, which track the bank base rate, will face an imminent increase in their repayments. Renters too are facing increases. Thank you so much for watching. Please considering like and subscribe my channel.